Testing, 1, 2, 3, mic check. Testing, 1, 2, 3, mic check. Testing levels, levels good, levels good. Hold on, let me double check this and make sure everything is right real quick. Make sure my mic sounds decent. Hold up. Testing, 1, 2, 3, mic check. Yeah, sound good, sound good. Sound good. Damn. Well, I was trying to get on here. I was trying to make it a little earlier. Wait, hold up. Make sure these hotkeys working. But the fuck, hey, why does this keep popping up on here? The S&P 500. Alright, I'm just trying to make sure everything's working right, dude. 1 second. Crypto. Oh, damn. Bitcoin's backside. What about Meta? Oh, Meta about to go front side on you. Damn, look at that dump. Bro, I was up early and everything, bro. But like, I don't know. Like, I couldn't muster up the energy to freaking jump on, dude. Like, I didn't want to get on and be all tired and shit. You feel me? And deliver subpar quality content. So I decided to just get my rest. You feel me? But guess what? Showing up is half of it. An old wise man once told me that. I think it was an old wise man. Someone told me that. I choose to believe it was an old wise man. Let me get rid of this real quick. Oh man, you can't see that anyways. Alright, so got a notification that what they raised it by 25 basis points. I mean, I guess that's what everyone expected anyways. So I don't let's see what the market actually did like throughout the course of the day. Alright, so off the open, bullish. Then we dumped. And then we kind of been grinding up ever since, putting in higher lows. I guess around here is around this. Oh, obviously here's where they announced it. Because look at the range on these candles. And now we're freaking shooting up, dude. At least we know there's some decent support down here. Right around here. At least intraday. We'll just put that level there. 410s. Yeah, seems about right. 410s. Coincides right here. Decent volume on this candle. About 5 million shares. Kind of like came down here and they bought it up off this level. We also chopped around it right here. We consolidated on it right here. So definitely that 410s is something. Even these levels from, I don't know, what was this yesterday? 415. The 415s seem to be significant as well. Let's get rid of those and kind of make it a little neater here. Yeah, about 415, 415.30s or so. A 415.30 as a level. Yeah, I mean, just so we know where the resistances or support could potentially be. You feel me? Looks like we're pretty bullish. I mean, market's looking my heat map is overwhelmingly green. I mean, as you can see. I mean, damn near the whole thing's green. So that's good. That's good. You feel me? The long term, the long term should be looking decent right now. I'm just trying to jump on here real quick, bro, because I feel like I'm obligated to. But yeah, dude. Ever since right around here, I mean, honestly, it looks like we're about to have a melt up for the rest of the day. For 11:11. Yeah. If if I know any better, it looks like we're gonna melt up for the rest of the day, bro. Tech is definitely looking stronger and leading. Look, the Qs are almost up here at the high of day. And looking stronger by the tick. And obviously, you know, they're correlated, so the SPY is going to follow. So I mean, I'd actually be looking at the 413 calls right now. Um, let's go to 0 days. It should be super cheap, being that we're like so close to look at this. Q's on the highs. 413s, what? 413 calls. Ah, they're about $1.60 right now. Oh damn, we don't hit 413 that quick, boy. I mean, the 414s are 120. The 415s are 85 cents. What about the Qs? Damn, they got my freaking shit. They got me looking at next month. Hold on. Let's get the weekly and quarterlies on here. I'm at the weeklies. All right, so the Qs got up here, made a new high. I mean, just a healthy little pullback here. Looks like we're gonna melt up though. I mean, we're just looking too bullish right now. And I mean, look, the S&P 500 is damn near on the highs. The high of day is 4143.02. We're not too far from that. I mean, even Bitcoin. Well, actually, let me see something. I mean, nice double bottom here, 28,203. That could be something to remember. Right around here. We came down here, double bottom and bounce, and then we just been putting in higher lows. And right now, I guess this is where they announced the 25 basis points. That's why you see so much volatility and range on these candles. I mean, that's what it has to be, because there's no reason. That's the only thing that would do that. Crazy volatility like that. An announcement from the Fed. So I don't even have to go back and double check that. Like, I mean, I'm pretty sure that's that. But like, I have this level drawn in here. 28. What is it? 28,675 or something like that. Obviously, it's significant. Let's go to the daily. See, that's one thing. Like, I don't know. I gotta go in and change my my setting, because my trend lines are supposed to be global, but for some reason they're not. But I think it might have to do with my different layouts as well. But yeah, this level right here obviously is significant. Oh shit. Nvidia doing Nvidia things, bro. On the highs, bro. Oof. Dog, Nvidia has been super bullish. I'm gonna close the preview. Hopefully I can remember what charts we're on. Damn, look at this thing just freaking ripping to the upside, bro. Wow. So what about, I mean, I would expect AMD to be doing the same thing. Look, AMD's going to follow NVIDIA. So should I be looking at those 83 calls right now on AMD? What about TSM? I mean, obviously, look at that, TSM on the highs. What the fuck? Let's look at SOXL on the highs as well. SOXL is pretty cheap. Grab some of that. SOXS on the lows. So, I mean, when you see that, bro, like, that's just more proof of concept for the bullishness. Now, let me look at what the fuck, they keep like spamming these things on. Let me check out my long term real quick, bro. Yeah, up decent. Damn. Ooh, I should have freaking added earlier. Like, that's what I forgot to do, bro. It's all good though. All right, what chart are we on? Hold up. Okay. All right, so now it's looking like the S&P 500 is kind of like taking a breather here, but I mean, dude, after a run up like that, you want to see some healthy pullbacks. You don't want to see it going straight up. Now, I don't like that. It seems like we're pulling back too far. But what I will say is, I mean, the first level we don't want to break past is this right here, which we're doing now. But the real level, I'd say, that we definitely don't want to give back is going to be around here. See where these two bodies of these candles kind of terminate here. We also have a rejection here and topping out here. So that is a level. So we can pull back. And actually, that might have been too low of a time frame. And look, I already have them drawing in on the 10-minute. So yeah, we can pull back. You know what I mean? Like you want to see some healthy pullbacks actually. If you want the uptrend to be sustainable, but you just don't want to be pulling back, past any type of significant level, like any consolidation or any chop, resistances or support. You know what I mean? But as long as we don't pull back and crack those, it's still good. But healthy pullbacks are definitely a good thing. You feel me? In my opinion. And Bitcoin's up here. I mean, we're well below 30K. I mean, it'd be nice for Bitcoin to get back up there. I don't know if we should watch Bitcoin or maybe the bonds. What about the 20-year treasury? And say, look, now that's a little more logical. You feel me? Like it makes more sense, for the bonds to be, selling off when the market's going up. It looks like we are pulling back a little bit here though. Because Nvidia hit a new high, and ever since we've been seeing a pullback like on the S&P 500. Obviously, the overall market's going to pull back at the same time. But what's encouraging is this can be considered a healthy pullback as long as we don't come back down and break down previous close and go backside. As long as we stay front side on Nvidia and Meta, which we're not doing here, and I don't know what the fuck just happened. We're dumping now. So I mean, I don't know if we can consider this a healthy pullback or not. Because I mean, honestly, the low of day is way down here, bro. But so it's still looking decent on the day, bro. But we're front side. But I would like for us to at least hold some of these gains here that we got off the off the announcement. You feel me? But I don't know. We're dumping right now, dude. Dumping decent, bro. Even Bitcoin. Meta's backside. Now Nvidia went backside. So is Big Dog talking right now? He might be talking. Let me try to find that real quick. I'm gonna just watch Bitcoin. Let's go over here to the main thing. Close the preview. All right, so we're pulling back here a little bit. Okay. He has to be talking or something. Let me try to find this. What would it be? Is it FOMC?
Markets are largely expecting the central bank to hike rates by another quarter.
At 2:30. Yeah, he's talking. That's what it is.
5,000 jobs per month. Employment rate remained very low in March, 3.5%. Even so, there are some signs that supply
I knew it.
and demand in the labor market.
We gotta find that. Hold up.
The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54.
Participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. But overall, labor demand still substantially exceeds the supply of available workers.
Uh-oh.
Inflation
It's
remains
not good
well
when he
above
goes to
our
freaking
longer-run goal of 2%. Over the 12 months ending in
stuttering
March,
and
total
shit.
PCE prices rose 4.2%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households.
So that's why we're seeing the volatility right now,
as well as measures from financial markets.
I knew it was something.
The Fed's monetary policy actions are guided by our mandate.
Oh,
to
dude,
promote
he's fucking
maximum
stuttering and shit, bro. We're about to dump, dude.
My colleagues and I are acutely aware that high inflation imposes
every time, bro.
Hardship.
Every time he starts stuttering and shit,
especially for those least able to meet the
costs of God, dude!
Like food,
wow.
Transportation.
Holy shit! Now do you believe me?
Inflation poses to both sides
when he freaking starts stuttering and shit, dude.
To returning inflation to our 2%.
Look at this, bro. Look at the S&P 500 now.
At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 5 to 5.25%. Let's get down in the trenches here, bro. And we're continuing the process of significantly reducing our securities holdings. With today's action, we have raised interest rates by 5 percentage points in a little more than a year. We
We'll
are
watch
seeing the effects
2
of
minute
our policy
candles, I
tightening on
guess.
demand in the most interest rate
Or should we
sensitive
get
sectors
all
of the
deep in
economy,
the trenches with the 1
particularly
minute?
housing and investment.
Gonna get deep
Take
in the
time,
trenches.
however, for the full
Let's go back
effects
over here.
of monetary restraint to be realized, especially on inflation. In addition, the economy is likely to face further headwinds from tighter credit conditions. Credit conditions had already been tightening over the past year or so in response to our policy actions
time I
and a
click on it.
softer economic outlook. But the strains that emerged in the banking sector in early March appear to be resulting
I know
in
there's a way
even
to
tighter
keep it
credit
on top.
conditions for households and businesses. In turn, these tighter credit conditions are likely
God,
to weigh on
bro, you
economic
heard the
activity,
stutter, bro?
hiring, and inflation.
We're going backside,
The
dude.
extent of these effects remains uncertain. In light of these uncertain headwinds, along with monetary policy restraint we've put in place, our future policy actions will depend on how events unfold. In determining the extent to which additional policy firming may be
Look
appropriate
at
to
this,
return
dude.
inflation
The
to
S&P
2% over
500 is
time,
about to crack and go
the
backside.
committee
We
will
just
take into
did.
account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity
Look
and
at Meta.
inflation, and economic and financial developments.
The fade from up here,
We will
dude.
make that determination meeting by meeting, based on
Hey,
the
look,
totality
always
of
do
economic
that.
data and their implications
Always
for
get
the outlook
tricked
for economic activity
into thinking
and
that we're
inflation.
like
And we are prepared to do more if greater monetary
we can be
policy
bullish
restraint
all of a
is warranted.
sudden.
We remain committed to bringing inflation back down to our 2%
He's remaining
goal
committed.
and to keep our longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
All right, well, here comes where the action happens at.
Hi, Gina Smilik, New York Times. Thanks for taking our questions. I wonder if you could tell us whether we should read the statement today as a suggestion that the committee is prepared to pause interest rate increases in June. And I also wonder
Supposed to
if
preview.
the Fed staff has in any way revised their forecast for a mild recession from the March minutes. And if so, what
even with
a
the
recession
preview open,
like
I'm
what
not
they're
dropping any
envisioning would look
frames.
and feel like
I'll just
when
leave
it
it
comes to,
open.
for example, the unemployment rate.
So, taking your question, of course, today our decision was to raise the federal funds rate by 25 basis points. A decision on a pause was not made today. You will have noticed that in the statement from March, we had a sentence that said the committee anticipates that some additional policy.
Look at the
firming may be
recovery on the
appropriate.
S&P 500.
That sentence is not in the statement anymore. We took that out, and instead we're saying that in determining the extent to
Recovery
which
as
additional
well.
policy firming may be appropriate to return inflation at 2% over time, the committee will take into account certain factors.
On
So
Nvidia and Meta.
that's a
Meta's trying to
meaningful
go front
change
side
that
here.
We're no longer saying that we anticipate. And so we'll be driven by incoming data, meeting by meeting, and we'll approach that question at the June meeting. So
Bro, these are the best
the
days to
staff's
trade. Like,
forecast
so
is-
much volatility, bro.
Let me start by saying that that's not my own most likely case, which is really that the economy will continue to grow at a modest rate this year. And I think that's, so different people in the committee have different forecasts. That's my own assessment of the most likely path. Staff produces its own forecast, and it's independent of the forecasts of the participants, which include the governors and the Reserve Bank presidents, of course. And we think this is a healthy thing, that the staff is writing down what they really think. They're not especially influenced by what the governors think, and vice versa.
Okay.
The governors are not taking
Back
what the
up on
staff
the
says and
highs
just
here.
writing that down. So it's actually good that the staff and
When we
individual
dumped and
participants
came up
can
down
have
here
different perspectives.
and never broke down and went backside.
So broadly, the forecast was for a mild recession.
That
and
was the play
that
right
I would
there.
characterize as one in which
Now look.
the rise in unemployment
We're on the
is
highs,
smaller than
dude.
has been typical
Everything's on the
in
highs.
modern era recessions.
Look at that.
I wouldn't want to
Nvidia
characterize
back up there.
the staff's forecast
not on the
for this
highs, but
meeting.
getting
We'll leave
close.
that to the minutes,
Meta,
but broadly similar.
not on the
to
highs, but have to be getting close.
Thank you, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. I'm wondering if you can talk about the account of possible effects of a debt limit standoff. You've said repeatedly that the ceiling must be raised, but do you see any economics effects of even getting close to a default? And what type of situation would that look like?
So I wouldn't want to speculate specifically, but I will say this. These are fiscal policy matters, for starters, and they're for Congress and the administration, for the elected parts of the government to deal with, and they're really consigned to them. From our standpoint, I would just say this. It's essential that the debt ceiling be raised in a timely way so that the U.S. government can pay all of its bills when they're due.
Hold on,
A
real
failure
quick,
to do
real
that
quick.
would
I
be
need to turn on
unprecedented,
the air.
would be
in
an
there. It's
uncharted
gonna
territory,
get too hot,
and the
dude.
consequences to
My
the U.S.
computer
economy would be highly
Starts getting
uncertain
hot.
and could
Shut
be
my
quite
monitor.
averse.
Give me 1 second.
I'll just leave it there. We don't give advice to either side. We just would point out that it's very important that this be done. And the other point I'll make about that, though, is that no one should assume that the Fed can protect the economy from the potential, short and long-term effects of a failure to pay our bills on time. It would be so uncertain that it's just as important that we never get to a place where we're actually talking about or even having a situation where the U.S. government's not paying its bills.
And just to follow up, was discussion around the uncertainty of a possible standoff, did that affect today's monetary policy decision at all?
I wouldn't say that it did. It was, of course, it's something that came up. We talk a lot about risks to the outlook, and that come up. A number of people did raise that as a risk
I
to the
forgot I
outlook.
had my
wouldn't say
Rocket
that was
Man on
important
there.
in today's monetary policy decision yet.
The hard questions get asked,
Thank you. Yeah, Mike.
and we start to dump.
Steve Leisman, CNBC. Can you tell us what the Federal Reserve Board did in the wake of that February presentation where you were informed that Silicon Valley Bank and other banks were experiencing interest rate risks? And can you tell me what supervisory actions you've done in the wake of the recent bank failures to make sure that banks are currently appropriately managing interest rate risk? And kind of part three, but it's all the same question here. Do you still think this separation principle, that monetary policy and supervision can be handled with different tools? Thank you.
Chroma
So the
keys
February
making my
14th
nose look all shiny.
presentation, I didn't remember it very well, but now, of course, I've gone back and looked at it very carefully. I did remember it. And what it was a general presentation. It was an informational briefing of the whole board, the entire board. I think all members were there. And it was about interest rate risk in the banks and lots of data. And there was one page on Silicon Valley Bank which talked about the amount of losses mark-to-market losses they had.
See
in
how
the
he's
portfolio.
starting to
There's
stutter
nothing
and
in it
shit?
that I recall anyway about the risk of a bank run. So
Oh my God, like-
I think the takeaway was they were going away to do an assessment, a horizontal assessment of banks. It wasn't it wasn't presented as an urgent or alarming situation. It was presented as an informational, non-decisional kind of a thing.
Let me
And I
just
thought
leave it
was a
alone,
very
dude.
good presentation, and as I said, did remember it. In terms of what we're doing, of course, I think banks themselves or many banks are now are attending to liquidity and taking opportunity now, really since
We're
since
talking about
the
that
events
bank
of
debacle.
early March to
We start
build
dumping.
liquidity. You asked about the separation
Bro,
principle.
these freaking options are fucking going
many
crazy,
things, it's
dude.
very useful. But ultimately, it has its limits. I mean, I think in this particular
413
case,
calls are
we
$1
found that
on the
monetary
spy.
policy tools and the financial stability tools are not in conflict. They're
413's
working
right here.
well together. We've used our financial stability
$1.05,
tools to support banks through our lending
$1.06.
facilities. And at the same time, we've been able to use our monetary policy tools to foster maximum employment and price stability.
$1.20. Some things just popped.
I don't mean to be argumentative, but the staff report said SVB has significant interest rate risk. It said interest rate risk measurements failed
$1.30.
at SVB, and it said banks with large unrealized losses face significant safety and soundness risk. Why was that not alarming?
Well, I mean, I didn't say it wasn't alarming. It was they're pointing out something that they're working on and that they're on the case. That I'm not sure whether they mentioned. I think they did actually. They mentioned that they had taken regulatory
Stuttering.
action, matter or supervisory action in the form of matters requiring attention. So I think that was also in the presentation. I think it was to say, yes, this is a bank.
We
and
got
many other
NVIDIA
banks
trying
are
to
experiencing
go
this
front side.
and we're on the case.
Meta trying to go front side. S&P 500. I mean, this is a higher low.
Turmoil, we've seen multiple banks buy other banks, and I was just curious whether you
Big
think
bank
that
take a little
further
bank.
consolidation in the banking sector would increase or decrease financial stability, and whether you have any concerns about the biggest bank in the U.S. Getting even larger.
So, we certainly don't, and I don't have an agenda to further consolidate banks. Consolidation has been a factor in the U.S. banking industry really since
run some
interstate banking, and before that,
some
even it goes back
security
more
here
than
real
30
quick.
years. When I was in the government a while back, I think there were 14,000 banks. Now there are 4,000 and change. So that's going on. I personally have long felt that having small, medium, and large size banks is a great part of our banking system. The community banks serve particular customers very well. Regional banks serve very important purposes.
It
and
looks
the
like
various kinds of
we're trying to
GSIBs
dump
do
a
as
little
well.
bit
So I
here.
think it's healthy to have a range of different kinds of banks.
If we
doing
crack
different
VWAP
things. I think that's a positive thing.
and come down here to previous close, we should
Is it a
bounce.
financial,
If we don't bounce off
I would
of
just say in
VWAP.
terms of J.P. Morgan buying First
JP
Republic,
Morgan,
the
JB
FDIC
Diamond,
really runs
popping
the process
fucking
of
bank-
closing
popping
and
banks
selling a closed bank
off the
completely.
clearance
That is
aisle-
their
off the
role, so I
clearance
really
aisle, bro.
won't comment on that process. As you know, there's an exception to the deposit cap for a failing bank. So it was legitimate, and I think the FDIC, I believe, is bound by law to take the bid that is the least cost bid. So I would assume that's what they did.
So, but do you have any concerns about the fact that they're getting larger in general?
Yes, JP
So
Morgan is getting
I think
larger.
it's probably good policy that we don't want the largest banks doing big acquisitions. That is the policy, and but this is an exception for a failing bank, and I think it's actually a good outcome for the banking system. It also would have been a good outcome for the banking system had one of the regional banks bought this company, and that could have been the outcome. But ultimately, we have to follow the law in our agencies, and the law is it goes to the least cost bid.
Yeah, right, man.
You,
You know,
Colton,
you know,
Financial
Jamie
Times.
Dimon
In
plugged
the
in,
meeting,
bro.
You mentioned that tightening of credit conditions.
That shit wasn't going nowhere but to Chase.
One or more
Period.
increases. So, given developments since then, how has your estimate changed?
Yeah, I think I follow that up by saying it's quite impossible to have a precise estimate of the words to that effect. But in principle, that's the idea. You know, when we've been raising interest
Meta's
rates, and that
breaking
raises
down
the
this
price of
level.
credit,
I don't
and
know
that
where I got
in a
it from,
sense
but
restricts credit
obviously
in the economy working through the price
it's
mechanism.
a
And,
significant
you
level.
know, when banks raise their credit standards, that can also make credit tighter in a kind of broadly similar way. It isn't possible to make a kind of clean translation between one and the other, although firms are trying.
Still
that.
high or low here
Trying,
on the
but
S&P
ultimately, we have to
500,
be-
so
we have to be honest and
If we
humble
can
about
hold
our ability to make a precise assessment. So it does
right
complicate
here-
the task of
Let
achieving
me
a
see.
sufficiently restrictive stance. But I think conceptually, though, we think that interest rates, in principle, we won't
I
have
mean,
to raise
definitely
rates
this
quite as
level,
high
it
as
would
we
be nice
have
to
had
hold.
this not happened. The extent of that is so hard to predict because we don't know how persistent these effects will be. We don't. know how
Hey,
large
he's
they'll be,
stuttering
how
too
long
much,
they'll
bro.
take
We're about to
transmit,
dump.
but that's what we'll be watching carefully to find out.
Just to quickly follow up, what does it suggest about the scope for the committee to pause rate increases perhaps as early as next month, even if the data remains strong then, if it's having some kind of substitute effect?
This is just something that we have to factor in as we wanna find
Stuttered.
ourselves. So I guess
Like,
I would say it this way.
again,
The assessment of
if
the
we
extent
if
to
we
which
don't
additional
if we
policy
sell
funding
off,
may be appropriate
I
is gonna be
believe
an ongoing
we'll bounce off a
meeting by
previous
meeting, and we're gonna
close.
be looking at the factors that I mentioned that they're listed in the statement, the obvious factors. That's the way we're going to be thinking about it. And that's really all we can do. As I say, it does complicate. We have, a broad understanding of monetary policy. Credit tightening is a different thing. There's a lot of literature on that, but translating it into rate hikes is uncertain. Let's say it adds even further uncertainty. Nonetheless, we'll be able to see what's happening with credit conditions, what's happening with lending. There's a lot of data on that, and we'll factor that into our decision making.
I need to figure out a hotkey to change the time
Howard Shire
frames.
with Reuters, thank you. So noting that the statement dropped the reference to sufficiently restrictive,
'Cause look, if
I
I-
was wondering,
once I click
given
on
your
it,
baseline outlook, whether you feel this current rate of 5
puts
to
it in the
5.25%
background.
is in fact
Here's what the
sufficiently
spy
restrictive.
looks like on the
It's gonna be
5-minute.
an ongoing assessment. We're going to need data to accumulate on that.
And here's the
Not
2.
an assessment that we've made.
We're gonna stay in the
That
trenches.
would mean we think we've reached that point, and I just think it's not possible to say that with confidence now.
I mean,
but
Apple,
Nonetheless,
we're starting to
you-
dump a little
you-
bit.
You will know that the summary of economic projections from the March meeting showed that at that point in time,
sold,
that the median participant
but
thought
again,
that this was the appropriate
Front side, I believe we hold and bounce off
high
of.
level of rates. We don't know that. We'll
I mean,
revisit that at the June
previous
meeting.
close.
And that's, we're just going to have to, before we
No,
really
the
declare
S&P
that, I think we're gonna
500's
have to
cracking
see, data accumulating and make that, as I mentioned, it's an ongoing assessment.
All right,
I follow up.
almost touched the
Could you
lows.
give us a sense of what the SLUIS survey indicated? It was
We're looking at the
already,
411 calls right now.
45% of banks were tightening credit as
They're
of
$1.30.
the last survey. What did this one show, and how did that weigh
$1.30
into your deliberations?
right now.
So we're going to release the results of this sluice on May 8th, in line with our usual time
Can't
frame.
wait till it
And
starts
I would
going
just
up.
say that the sluice is
Right now.
broadly consistent when you see it with how
Yeah,
we
once
and
they
others
start
have been
going up,
thinking
they
about
jump
the
in price.
situation
Now
and
the-
what we're seeing from other
Now
sources.
they're
You will
$1.40.
have seen the beige book and listened to the various earnings calls that indicate that mid-sized banks some of them have been
Look.
tightening their lending standards.
So what we
Banking
came
data
down
will
here,
show that
consolidated,
lending has
and
continued
bounced.
to grow, but the pace has been slowing really since the second half of last year.
Now they're 170. Oh, bro, I'm telling you, dude.
Nick Tamaros of the Wall Street Journal.
190.
Chair Powell, the argument around the end of last year and the beginning of this year to slow down the pace of increases was to give
what was
yourself
that,
time
like
to study the effects of those
Quick
moves.
70,
After the bank
70
failures in
cents,
March,
70
as you
bucks.
discussed, the Fed staff projected
one
a
contract?
recession starting
And
later
you could have
this
been
year.
out of the play
So
already.
the question is why it was necessary to raise interest
From
rates
right here to
today,
right
or
there.
Put differently, if
Quick
the whole
little
point of
80
slowing down
bucks
the pace
on one contract.
was to see the effects
Could've
of
been
the
out.
moves, and now you've, for the last
Or
two meetings,
pretend,
been
you know what I
seeing
mean?
the
A quick
effects of
800.
those moves. Why did the committee feel it was necessary to keep moving?
Well, the reason is that again, with our monetary policy, we're trying to reach and then stay at for an extended period, a level of policy stance
what did I
that's
say?
sufficiently restrictive to bring inflation down to 2% over time.
Did I say we
And,
come down the previous close and
That's what
bounce?
we're trying to do with our tool. I think slowing down was the right move. I think it's enabled us to
Did I call
see
it?
more data, and it will continue to do so.
And now that we're like on VWAP
we really,
and they're buying it up,
we have to balance. We always have to balance.
I
the
feel
risk
like we're
of
gonna-
not doing enough.
we
And
should
not
melt
getting
up as
inflation
long as
under
they don't
control
ask the wrong shit
against the risk of
right now.
maybe slowing down economic activity too much. And we thought that this rate hike, along with the meaningful change in our policy
Hey,
statement,
stuttering,
was the
dude.
right way to balance
Come
it.
on, man.
And just to
Get your
follow
words
up,
together,
you
dude.
You said in response to Howard's question, you'll need data to accumulate to determine if this is a sufficiently restrictive stance. Does that data need to accumulate, or could it accumulate
170
over a
still.
longer period than a 6-week intermeeting cycle?
As I mentioned, I would just say that this assessment will be an ongoing.
Easy money.
You can't with economic data. You can't. You've seen take inflation from it. Look back. We've seen inflation come down, move back up 2 or 3 times since March of 2021. We've seen inflation have a few months of coming down, then come right back up. So I think you're going to want to see that.
I guess F1 is a hotkey for
A few months of data will persuade you that you've got this right.
Google or
kind of
something.
thing. And
Or YouTube.
we have the luxury. We've raised 500 basis points. I think that policy is tight. I think real rates are probably, you can calculate them many different ways, but one way is to look at the nominal rate and then subtract a reasonable estimate of let's say 1 year inflation, which might be 3%. So you've got 2% real rates. That's meaningfully above what most people would, many people anyway, would
Look at that, dude.
as the neutral.
411s are
Policy is tight.
215
And you see
now.
that in interest sensitive activities, and you also begin to see it more and more in other activities. And if you put the credit tightening on top of that and the QT that's ongoing, I think you feel like we may not be far off.
What's that? About 2 million shares?
Thank you very much, Chair Powell. Edward Lawrence with Fox Business. So if the Federal Reserve gets down to the 3%
500,000
inflation as the projections show at the end of this year, or close to it, would it be okay for you for a prolonged period of 3% inflation and hoping for some outside event to move down to 2% target?
I think we're always going to have 2% as our target. We're always going to be focusing on getting there.
Would be okay with a prolonged 3%?
It's let me just say that's not what we're looking for. We're looking for inflation going down to 2% over time. I mean,
NVIDIA
depend on so many other things.
fighting. Rejecting off of previous close.
Our tools. We have
a
goal of getting to 2%.
They stuttering. They're asking hard questions. That's why we're dumping right now.
And I think we're gonna need to stay at this for a while.
Damn, we're gonna need to stay at this for a while. That's pretty hawkish.
The other side of the
They will both matter equally at that point. Right now, you have a labor market that's still extraordinarily tight. You've still got 1.6 job openings, even with the lower job openings number, for every unemployed person.
Those
do see
you'd have been out of that play already.
Softening in labor market conditions
From here to here.
You're near a 50-year low in unemployment. Wages, you all will have seen the wage number from late last week, and it's whenever it was, and it's a couple percentage points above what would be consistent with 2% inflation over time. So we do see some softening. We see new labor supply coming in. These are very positive developments. But the labor market is very, very strong. Whereas inflation is, running high, well above.
Labor market's very, very strong.
Focusing on bringing inflation down.
It's actually
been able to do that so
bearish
far without unemployment going up.
It's bearish for the stock market because that means they can continue on the same path of monetary policy tightening.
Imply or seem to imply that a recession was in.
Come on, bro. Why don't you get a haircut, dude?
Strong first quarter
GDP someone give this dude a fade, bro.
Kind of
what's up with this?
On, why you're optimistic that a recession can be avoided, given that that's
someone run and give that guy a fade right now, bro.
Also, the broader committee's
please
as well, and
I
also,
beg you.
Of course, most private sector forecasts.
Can't even look at that, dude.
I don't think.
Sorry, bro.
I know what's printed in the summary of economic projections and all that. I don't think you can deduce exactly what you said about what participants think, because you don't know what they were thinking for first quarter GDP at that point. They could have been thinking about a fairly low number. Anyway, in any case, I'll just say I continue to think that it's possible that this time is really different. And the reason is there's just so much excess demand really in the labor market. It's interesting, as we've raised rates by 5 percentage points in 14 months, and the unemployment rate is 3.5%, pretty much where it was, even lower than where it was when we started. So job openings are still very, very high. We see by surveys and much evidence that conditions are cooling gradually, but it really is different. It wasn't supposed to be possible for job openings to decline by as much as they've declined without unemployment going up. Well, that's what we've seen. So
it's so fucking wonky, bro.
This, but it just seems that,
when I put on
that it's possible
indicators,
that we can continue to have a cooling in the labor market without having.
Can we start a petition to get this guy a haircut?
Prior episodes. Now that would be against history. I fully appreciate that. That would be against the pattern. But I do think that
it's so wonky
that the situation in the labor market with so much excess demand
when
yet,
I put on more indicators,
wages have been moving down.
like-
Wage increases have been moving down.
but
And that's a
I
good
think
sign.
it's because
Down to more
I have
sustainable
it
levels. So I
like
think
the
I think it's still
volume on the
possible.
thing where it
I
estimates it.
think, the case of avoiding a recession is, in my view, more likely than that of having a recession. But it's not that the case of having a recession is. I don't rule that out either. It's
Hey,
possible that we will have.
But
what I
getting
hope
my
would be
bar
a
data.
mild recession.
The committee also noted in March that wage growth was still well above levels that would be consistent with 2% inflation.
Bro,
Do you see that as well? And
please.
could you kind of explain, how
Could you get
come
him
to
a
that
haircut, bro?
Sure. So we look at a range of
We need a
wage,
petition.
wage measures, and then that's a nominal, and then so you assume wages should be equal to productivity increases plus inflation, and so you can look at the employment compensation.
His hair look
index,
better than
average
some of
hourly
y'all
wage,
girls,
Atlanta
bro.
Wage tracker.
That ain't
compensation
right.
per hour, basically those four and many others, and you can look at what they would have to run at over a long period of time for that to be consistent with 2% inflation. They can deviate. Corporate margins can go up and down, and there is a feature of long expansions where they do go down, where labor gets a bigger share toward later in a recession. Later in an expansion. So yeah, and we calculate those, and you have to take the precision with a degree of salt. But I would say that what they will show is that
Better have that 120 on that thing,
if
bro.
wages are running at 5%, 3% is closer to where they need to be. Wage increases closer to 3%, roughly, is what it would take to be consistent with inflation over a longer period of time. By the way, I do not think that wages are the principal driver of inflation. You're asking me a very specific question. I think there are many things. I think wages and prices tend to move together, and it's very hard to say what's causing what. But I've never said that,
It's very hard to
wages
say
are really
what's
the principal
causing
driver,
what.
because I don't think that's really right.
I don't think that's something you should be saying, bud.
Great. Christopher Gaber at Associated Press. Well, you mentioned profit margins. Those have expanded, did expand sharply during this inflationary period. And while there are some signs that they are starting to decline, many economists
They're
note they
asking
haven't
the
fallen
hard
as much as
questions.
might be expected, given that we're seeing at least some pullback among consumer spending. So
We're seeing some
speaking of
pullback
causes
in
of
the
inflation,
market.
Do you see expanded profit margins as a driver of higher prices? And so would you expect them to narrow soon and contribute to reduced inflation in the coming months?
So higher profits and higher margins are what happens when you have an imbalance between supply and demand. Too much demand, not enough supply. And we've been in a situation in many parts of the economy where supply has been fixed or not flexible enough. And so, the way the market clears is through higher prices. So I think as goods pipelines have gotten, back to normal, so that we don't have the long waits and the shortages and that kind of thing, I think you will see inflation come down, and you'll see corporate margins
What's
going
up
down
with
as
the
a result of
stuttering,
a
dude?
return of full competition where there's enough supply to meet demand, and then you're really back to full competition. That would be the dynamic I would expect.
Michael McKee from Bloomberg Radio and Television. Can you tell us something about what your policy reaction function is, your policy framework is going forward? When you look at the economy at the next meeting, are you looking at incoming data, which is by definition backward looking? Are you going to be forecasting what you think is going to happen? Are you ruling out the rate cuts that the market has priced in?
I didn't catch the last part. Rolling.
Markets have priced in rate cuts by the end of the year. Do you rule that out?
Okay, I got it. So what are we looking at? I mean, we look at a combination of data and forecasts. Of course, the whole idea is to create a good forecast based on what you see in the data. So we're always looking.
I
at
mean,
both, and it will, of course.
honestly,
it'll be
we're not in a
it'll be
bad
readings
spot.
on inflation. It'll be readings on wages, on economic growth.
S&P
on the
500's
labor
front
market,
side.
And
Nvidia
all those
is
ratings.
going
I think
front
the
side right
particular
now.
focus for us going now over the past
It's fighting
6,
for
7
it.
weeks now.
It
going
looks like
forward
it's
is going to be
eventually
what's
going to break
happening with credit
past
tightening.
previous close
Our small
and go
medium-sized
green on the
banks
day.
tightening credit standards. And is that having an
Decent
effect
level down here on Meta, bro.
loans, on
What is
lending?
this,
And, you know, so we
237.70s?
can begin to assess how that fits in with monetary policy.
Look at that.
That'll be an important thing. I just, you know, we'll be looking at everything. It's, again, I would just point out, we've raised rates by 5 percentage points. We are shrinking the balance sheet.
237.70s.
Now we have credit
Look,
conditions
NVIDIA
tightening, not
goes
just
front
in the normal
side.
way, but perhaps a little bit more.
We might see the
What's
melt up.
happened. And we have to factor all of that in and make our assessment of, you know, of whether our policy
Because
stance is sufficient.
basically, we've been trading
And
within
we have
this
to do
range
that in a
here
world where policy works with long and variable lags.
for
So this
the
is
most
challenging,
part.
But, you know, we
From
we
here
make our best assessment, and that's
to
that's
about
what-
here.
What about the idea of rate cuts?
Yeah, so we on the committee have a view.
The SPY's
that
front side, the Q's are front
inflation's
side.
going to come down, not so quickly, but it'll take some time.
Oh my God.
And in that world, if that forecast is broadly right, it would not be appropriate and to cut rates, and we won't cut rates. If you have a different forecast, and you know, markets have been from time to time pricing in, you know, quite rapid reductions in inflation. You know, we'd factor that in, but that's not our forecast. And of course, the history of the last 2 years has been very much that inflation moves down, particularly now if you look at non-housing
Well, so
services.
we're
it really,
dumping right now.
It really hasn't moved much, and it's quite
Look at the
stable,
S&P
and,
500.
you know, so we
But
think we'll have
remember,
to, demand will have to weaken a little bit, and
we
labor
come
market
back down here and
conditions will
test
soften a
previous
bit
close
more
again.
to begin to see
I
progress
believe
there.
we get
And
another
again,
bounce.
In that world, it wouldn't be appropriate for us to cut rates.
Courtney Brown from Axios. I'm curious how you view the role of the overnight
Dumping.
reverse repo facility in the context of the current banking stress.
All right, so
Do you
look,
think it's contributing to the stress?
come
by
down
making
where it came back
more
down here, the previous
attractive
close.
for
Look,
money market funds to compete with banks
right
for
here at this
deposits?
410s.
And did the committee discuss
Where you
any
jump on the 411s
changes
at.
to the structure of the facility? Or
Eh,
do you see that being put on the table in the
missed
future?
it.
Thanks.
Sure. So we looked at that very carefully, as you would imagine, and you know, it's really not contributing. We don't think now. It hasn't actually been growing. You know, it moved up, it moved down, and then moved back up to where it was.
The
What
411s
happened
are
when
like
the,
one.
when there was the
110?
big deposit flows, which by the way have really stabilized now.
Went down
What
to a
happened
dollar
was
for a
institutional
second.
investors took their uninsured deposits and put them in government money market funds, which bought paper from the federal home loan banks and things like that.
We come
over
down
the
here
course
and
of,
dip. See right now, 411s.
Maybe the last year,
They're a dollar.
retail investors had been
Right now.
as they do in every tightening cycle, they've been gradually moving their deposits into
I
higher
don't
yielding
ask.
places such as CDs and
Yeah,
other things,
I can-
including money market funds. So that's a gradual process that is quite natural and happens during
Oh,
a,
it's pulling up the
tightening
data.
cycle. What
Look,
was
here's the
unusual,
actual chart
well, it was
from.
the institutional investors moving their
No, this
uninsured
is cool right
deposits and
here.
spreading them around and things like that. But
Hold on.
it doesn't seem to have had any effect overall on the over the.
Look, this
overnight
is the
repo
this is
facility.
the chart of the
Um,
actual
That
contract.
is really there to help us keep rates where they're supposed to be, and it's serving that purpose very well.
I don't know. It's taking so long.
Sarah Ewell Weiss, CBS News. I want to go back to
Look,
the debt ceiling
these
for a moment.
this
I know
is
you
the
talked
this
about
is
that
the
in terms
chart
fiscal
of the
policy,
actual
but can you just
contract.
speak towards what the impact of a default would mean for Americans across the country, the markets,
The
and borrowers?
411 calls.
Yeah,
So look, they're
I
99
would
cents
just say
now.
it's
a dollar.
I don't really think we should be. We shouldn't even
See?
be talking about a world in which
Well,
the U.S.
look.
doesn't pay its bills. It just shouldn't be a thing. And again, I would just say we.
So like
we,
right around
we
here.
should assume that the Fed
Remember, I
can
were
do-
like they were like a dollar or
can
something.
really protect the economy and the
They
financial
went up
system and our
to
reputation
like
globally
170 or
from the
$2
damage
or
that
something.
such an event might inflict.
Thanks, Mr. Chairman. Scott Horsley from
That's
NPR.
it. Now them-
In his
now they're
report, Vice
82
Chair
cents.
Barr identified a couple of the factors that he
85
thought
cents.
contributed to the
80
or the supervisory lapses.
A-
of Silicon Valley
86
Bank.
cents. You could
Policy
see it
change
here,
in
too.
2019 to exempt all but the biggest banks from strict scrutiny.
So
And
this
also
is the
what he
actual
called a sort of
411
cultural
call
shift
on the SPY right here.
towards less aggressive oversight. You were here in 2019. Do you
You
share
can
that
actually
view?
trade them like
And
that
what would
too.
it take to get the the stronger.
just by looking at the
oversight
chart.
he said
That's,
in your
I
proposal
mean,
necessary.
I've never done it,
So
but
I didn't.
I think there's
I
an
didn't
edge
take
to
part
be
in
had there.
creating the report or doing the work, but I have read it, of course, and I find it persuasive. I mean, I would say it this way. A very large.
No,
a
so
large bank,
we're
not a
kinda
regular
dumping
bank,
right now?
A large bank failed quite suddenly and unexpectedly.
On the
in a
lows
way
now.
that threatened to spread contagion into the financial system. I think the only thing that I'm really focused on is to understand what went wrong, what happened, and identify what we need to do to address that.
Looks like I have a level
Some of
down
that
here.
it may just have been
409
technology evolving,
40s.
You know, we have to keep up with all that, but some of it may be our policies and
And I have a level here on the Qs.
whatever.
We're cracking
what
it.
our job is now is identify those things and implement them, and that's kind of the only thing I care about is. And I think I feel
All right,
like
so
I am accountable.
the third
for
time was not the
doing
charm.
everything I can to make sure that that happens.
Well, as you can see, on the S&P 500, we're dangerously close to the lows.
Thank you. Evan
Selling
Moser
off
with
so hard, even
MNI Market
Bitcoin
News.
selling off.
Chair Powell, are we in the early stage or nearing the end stage of the banking turmoil among regional banks?
We're in the mid
And
stage.
secondly, do you still have a bias to tighten rates? Is that what the statement is saying?
So, I guess I would say it this way.
All right.
There were
Let's
three
zoom out a little bit.
large banks, really, from the very beginning, that were at the heart of the
Let's
stress
see
that we
if we can-
we saw in
if
early
there's
March, the
anywhere we
severe
can
period
bounce off
stress.
of.
Those have now all been resolved, and all the depositors have been protected. I think that the
And we
resolution
cracked
sale
that.
of
So,
First Republic kind of draws a
we're
line
trying to
under
crack
that
right
period
here.
of is an important step toward drawing a line under that period of severe stress. Okay, I also think we are very focused on what's happening with credit availability, particularly with what you saw in the beige book, and you will see in the SLOOS is small and medium-sized, small
So
and
right,
two
right
medium-sized
around
banks
here, there's a level.
are feeling that they need to tighten credit standards, build liquidity.
Intraday.
What's going to be the macroeconomic effect of that?
409,
More
80s.
broadly,
It looks like
we
we're cracking
will
it though.
Continue to very carefully monitor what's going on in the banking system, and we'll factor that assessment into our decisions in an important way going forward.
So I'll be looking at those 410s now. They're $1.
Thank you, Fed Chairman. Greg Robb from Market Watch.
The 410s.
If you've done any reflection on your own.
No, now they're $1.10.
During this crisis and leading up to it.
$1.15.
Since you've been Fed Chairman, I think I've heard you say a couple of times that you
$1.25.
deferred to the Vice Chair for supervision. Do you think that was the right way to go about this? And
25 cents.
Yep. Comments on that.
Real quick.
Sure. So let me say, first
25
of all,
bucks.
I've been chair of the board
You know what I mean?
for 5+ years now.
And about,
I fully
what
recognize
was
we
that,
made mistakes. I think we've learned some new
I don't
things
know.
as well, and we need to do better.
20
And
seconds,
as I
30
mentioned,
seconds?
I thought the report was unflinching and appropriately so. I welcome it, and I agree with and will support those recommendations, and I do feel that I'm personally accountable to do what I can to foster measures that will address the problems. So
What
on
was
the
I
Vice
saying?
Chair
The
for supervision,
410s?
The
120.
place to start is the statutory role, which is quite unusual. The vice chair, it says, shall deploy policy recommendations, develop policy recommendations for the board regarding supervision and regulation of depository institution companies, and shall oversee the supervision and regulation of such firms. So this is Congress establishing a 4-year term for someone else on the board, not the chair, as vice chair for supervision, who really gets to set the agenda for supervision and regulation for the Board of Governors. Congress wanted that person to have political accountability for
Alright.
developing that agenda. So the
So
way it
the
works, the way this
410s
worked in practice
are,
for me
95 cents
is
right now?
I've had a good working relationship. I give my
It's
counsel.
kind of be risky though. Like, this is a substantial dump right here and sell
I
off.
offer that, and I have good conversations, and I try to contribute constructively. I respect the authority that Congress has deferred
On the
that
lows here, bro.
including working with Vice Chair Barr and
But-
his predecessor. And
if you think about it,
that's the way it's supposed to work, and that's
I mean,
appropriate.
everyone
I
expected
believe that's what the
25
law
basis
requires.
points.
And, you know,
So
but it isn't. I
when
wouldn't
it's all
say
said
it's a
and
matter of
done,
complete
and the press
deference.
conference
It's
is over,
I have
I believe
in presenting my views and discussing
dip buyers
having an intelligent
come back in
discussion
this
about what's
thing.
going on and why, and you know that's my input. But ultimately, that person does get to set the agenda.
But look,
and
the
gets to
410s
take
now are
things
only
to the
80
board of governors.
cents.
And really, in supervision, has sole authority over supervision.
No, they're 90 cents.
Just wondered if you had any regrets. Or was
They
there
jumped
anything
up
that,
10
you know,
cents, $10.
decisions that maybe you regret now in light of what's happened.
Look. All
Sure,
right, now
I
they're
mean,
$1.
You know, who doesn't look back and think that you could have
All
done
right, so
things
they went
differently?
up
And
20
honestly,
bucks.
You don't get to do that. Again, my focus is on what you control the controllable. As one of my great mentors used to always say,
They're
control the
fluctuating a
controllable.
lot.
What we control now is make a fair assessment, learn the right lessons, figure out what the fixes are, and implement them. And I think that Vice Chair Barr's report is an excellent first step in that, but we've got to follow through.
Hi there, Megan Casella with Barron's. Did the possibility of pausing at this meeting come up at all, and how seriously was that considered? I'm curious if you can give us any color as to whether there were any initial concerns about raising rates again, or what those discussions entailed.
So support for the 25 basis point rate increase was very strong across the board. I would say there are a number of people, and you'll see this in the minutes. I don't want to try to do the head count in real time, but people did talk about pausing.
The
but
only
not so much at
thing
this meeting.
I would be
You know, that
concerned
we're-
about now
there's a sense
is
that
because we're under
that
previous close.
we're much closer to
So
the end of
obviously
this than
that's
to the
going to act
beginning,
as a
that, you know,
resistance.
as I mentioned, if you add
But
up
the
all tightening that's
Qs
going on through various
are trying to
channels,
break past it right now.
we feel like we're getting close or maybe even there.
Oh, look, now
But
they're
again,
worth
that's gonna be an
one,
ongoing assessment, and we're gonna be
115,
looking at those
120,
factors,
125,
that we listed in
130.
to determine whether there's more to do.
So from 80 cents to 130, it's 50 bucks.
Is the bar higher now to raise rates at the next meeting, or would a strong jobs report or inflation print be enough to push the Fed to tighten again?
I don't want to. I couldn't really say. I just think I think we've moved a long way fairly quickly, and I think we can afford to look at the data and make a careful assessment.
All right, so like if we dip back down here to like under 410s,
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. You mentioned a few times about the lessons you learned from the banking crisis.
I'll
that
be
you
grabbing the
learned the right
410s.
lessons.
I mean, you can grab them now, but they're worth
just
a
gonna start
dollar.
with,
They're like $1.10 right now.
That's
Well,
changed really.
They
which
were
is,
80 cents.
The run on Silicon Valley Bank was out of keeping with the speed of runs through history, and that now needs to be reflected in some way in regulation and in supervision. We know now that we know it's possible.
Yeah,
I
so
think no one thought that was possible. No one had. I'm
All
not
right.
aware of anybody.
Right
thinking
now,
that
the
this could happen
410s.
quite so quickly. So I think that
Under a
that will
dollar.
play through. I'm it will be up to Vice Chair Barr to really take the lead in designing the ways to address that. But I think that's one thing. I guess I would just say that then that we're gonna revisit. It's pretty clear to me anyway. It's clear that we need to strengthen both supervision and regulations for banks of this size, and I'm thinking that we're on track to do that as well.
Can you be any more specific on stress testing or looking at banks that have specific concentrations in certain parts of the economy?
Yeah, that's what Vice Chair Barr's role really is, and he'll take the lead on that.
Okay, thank you.
Thank you.
All right, let's get that off of there before they hit me with the copyright. So yeah, look, we're on the lows right now. Where's the low a day at? I'm at the support. I mean, going back to yesterday, we have some here. But honestly, bro, I feel like they didn't tell us anything that we didn't already know. So therefore, everything went pretty much expected as planned. But the only thing I'd still be looking at those 410 calls, especially now. Look, they're only 70 cents, right? The only thing that has me worried, would have me worried, is how much we ran up on the anticipatory run up. Because if we ran up too much on the anticipatory, then it makes sense that we'd have to give a decent amount back. You feel me? So, I mean, we kind of did run up. Got as high as 413. So, that's the only thing that would have me iffy on grabbing the calls. And now, I mean, I definitely wouldn't be trying to take a long position with the S&P 500 looking like this, bro, on the lows. I mean, Meta is still backside, but I've seen worse. Look at Nvidia, dude. That thing dumped all the way down to 274, 75s and got up to 283. That would have been a decent swing trade right there. Look at that. No stress. Just enter the position and ride it all the way up to the high and get out. You're done after that. Now remember what I was saying. Look at this wick off the low. They bought it up. So look, damn, came down here and bounced perfect off that 4100. Look at that. I've had this level drawn in here for weeks. Perfect bounce off that thing, bro. Nice psych level, 4100. You heard me say it. I'd still be looking at the 410s because honestly, they didn't tell us anything that we didn't already know. We already knew they were raising by 25 basis points. So basically, all that volatility was just Chairman Powell just talking. You feel me? And the market's reacting off of what he was saying, and more importantly, how he was saying it. But if you just look at everything, I mean, at face value, like, they didn't tell us anything that we didn't know. Therefore, there's no need, there's no reason for us to dump more than we already have. And I would be, again, looking at those 410s. Look, the Qs are here. We're trying to go front side again. You know the SPY's going to follow. Look, now they're back up to over $1. Down here, they were 80 cents. And down here, they were like 70 cents, 75 cents. Now, they are $1.10. Let's click on those and see what they look like on the chart. The 410 calls. Here's what they look like on the chart. This is the 410 call, same day expiration. Look, at one point they were worth $4 and 20 something cents. Earlier in the trading period. Now they're worth 90 something cents. That's cool, right? I don't know. I think that's cool. How you can actually look at the actual derivative, like the specific contract on the chart. So like imagine looking at the actual price action of the underlying along with the option chain, and also the chart, the price action of the actual instrument, the contract. I feel like that could be exploited as a decent edge if you're you feel me, trading these derivatives intraday. I mean, we're well within power hour. Well, looking like Apple's trying to come down here and test previous lows again. I mean, it's hard to call right here only because we're well within power hour, and also we have to take into consideration the 10 minutes of terror. You feel me? But the S&P 500, I mean, bounced decent off that 4100 handle. Let's see if we can maintain a higher low here. I'd say 4108 is one I would want to hold as a higher low, just because we came down here and like bounced. They bought it up from this level, as you can see from these wicks on the bottom here. But we've just cracked that, so bonds are front side. That's the 20-year though. I just seen a violent little jerk. See, look, that's more logical. As the market's selling off, the bonds are going up. Because it's like a hedge. You feel me? So that makes sense. You know what I mean? Because like bonds is just another place to park your capital when there's too much volatility in the markets, or inflation's too high, or whatever. What you know what I mean? Whatever the situation is. So that is logical. And as it looks like the bonds are like trying to step up and put in higher lows. Look, as you started to see a little weakness in these 20-year treasuries, you started to see like the S&P 500 try to bounce. But one thing I don't like is we cracked 4100. We cracked 4100, and look, they're buying it, going up. I should be able to type in the exact level I want. Alright, 4,100. I mean, we must stay above 4,100, bro. If we can't get back above 4,100, then my bad, I was on the wrong chart. If we can't get back above 4,100, bro, then we may continue to see some bearish price action here. But look, the bonds kind of like topped out a little bit, but that could also be like a healthy pullback. You have to keep that in mind. And it looks like that might be what it is, because it seems like the S&P 500 is just staying on the lows and consistently putting in a new low. And you see this wick here? Where they're buying it. So let's go ahead and just put a level here to let us know that if the bonds go ahead and break past this chop here, to the upside, obviously, then we're going to see more fading in the market. And see how they're buying it up? See the wick on the bottom here? Pushing it right up to that level where there's a little intraday resistance there. And the S&P 500 is consistently on the low here. Meta's backside by a long shot, actually closer to the lows than the highs and heading lower. Nvidia fading as well, cracked VWAP. Damn, I don't have a VWAP on this. Hold up. All right. So Meta, yeah, definitely below VWAP. S&P 500 continuing the leak and stay on the lows. Look, see these wicks on the bottom here? That's 1, 2, 3. You feel me? That they're buying them up, and that's consolidation. Okay, so a little slight rejection off the top of the range here. I would expect to see this thing getting bought. And that's what we see. All right, so the 409s, they're 50 cents. Only thing that scares me is we still have the 10 minutes of terror to worry about. But look, if the S&P 500 can get back up here to 4,100 and break past it, and look, bonds are dumping now. So look, the S&P 500 is going up here to test this 4,100. It seems like we are going to break past it. So we could also have the inverse 10 minutes of terror, which is basically a melt up, like a run up going into the close that last 10 minutes. I've seen that happen maybe, I don't know, 8 out of 10 times, 8.5. I'm sorry. About two times out of 10, or 1.5 times out of 10 I've seen the melt up, the inverse 10 minutes of terror. And on a day like this, I feel like we could see that today. Again, contingent on what the S&P 500 does here at this 4100 handle. But if you're looking at the bonds, I mean, they topped out and obviously are now fading, actually cracked previous close and putting in a bearish pattern. Looks like Meta stopped fading for a little bit here and is attempting to put in a higher low. So it looks like on the 5. What's Nvidia look like on the 5? Let's see if this is a level here. Yeah, definitely. Right there, look. It's intraday, but going straight across here, see that? Chopping around, acting as support, cracked it, acting as support, came back down here. Now on this level, let's see if it continued to act as support. And that is what? About 278.40s, 278.50s. Again, look, this thing's fighting. But if we can break above 4100, right, putting in some higher, putting in a higher low, consolidating. Contingent on this. It's 4100 handle. Making a push. Making a push. Making a push. Making a push. 40.99.36. Trying to reclaim the 9 EMA. I also see bonds making a push as well. So I don't know, it's hard to call here. See how bonds are like putting a higher low and trying to look bullish. As you see that, weakness creep back in. Oh shit. Oh no, dog. It looks like we're dumping. It looks like we're slumping. Bonds are on the high. We're not the high, but they looking like they about to fly to the upside. Gotta break past this chop. Now we're dumping, dog. Ooh, now we're slumping, dog. Well, I don't know, bruh. They're playing with it. Now look, bonds freaking rejecting off that level again. As this thing, I mean, we're way below 4,100. That beat though, right? Hear the violin? On the hi-hat and the drums and the 808. I made that on my stream, dog. I played that. And man, I played cats. Also had the spray cats when they ran up. Got a lot of haters, but they really fans, cuz. To keep it real, I keep the steel. Knock your ass off, and I keep the peel of your. Alright. I didn't want to say that. I don't know, man. Nvidia below VWAP, Meta below VWAP. Bonds up here again, playing with this level. Topping out on it. Let's see if we can break above it. See that wick? Lets me know there's buyers. Weakness come in. S&P 500 trying to break past the 9. Damn, dude, I wanted to stay and watch the 10 minutes of terror, bro, but I can't. Fucking sucks, dude. My schedule's all jacked up right now, bro. But I'm getting things in order. Damn. What do you think? We just dumped going into the close? 10 minutes of terror? That's what it looks like, dude. Well, look at these higher lows getting put in here. I mean, dude. Same day expirations. Like, we're too close to the close now, dude. There's no intrinsic value left in them. That's what makes them so cheap. Like the 409s are 37 cents, 38 cents. But and I mean, honestly, bro, the freaking S&P 500 broke down 4,100. Not good, bro. And look at bonds. They broke past that chop now. I mean, looks like they're both. I mean, bonds are definitely trying to push up here. Okay, so we got Nvidia playing around with VWAP, trying to cross back over. Meta also rejecting off of VWAP. Looks like Nvidia is about to cross over VWAP. The hell? Ten minutes of terror, bro. Oh shit. You know what that means? When that beat come on, bro. I mean, bro. That's my scary freaking dumping beat, bro. My slumping beat, bro. Bonds riding. I'm talking about them things can sliding to the upside. What's up, guy? What you trying to do? I'm just hustling, getting money, and trying to. But they keep trying to stop me. If they were smart, they would just copy. I'd knock your ass off. It could be neat or sloppy. It don't matter, man. As long as my pockets get fatter, man. Around your ass get splattered, man. Real shit. Real quick. Don't try me. I have to ask why me. Yeah. 10 minutes of terror. Let's see it. Uh-oh. Uh-oh. The 408 puts are 40 cents on the ask. No, they're 50 cents. Right there could have been a quick 10 bucks on each contract. Just that quick, man. Yeah, my bad. Yeah, dude, it's looking like that 10 minutes of terror has already started. Any calls are dearly departed if they were short term. Look at Tesla still front side though. Damn, son. Okay. You see Elon. Yeah. Really quick. Let's just take a quick overview of what we have. Oh shit. Look at Meta. Making another run, bro. I mean, still backside by a long shot, but look. Nice little double bottom down here, and from there we just been grinding up. To about 235.50s. Nvidia kind of looking like it wants to make another run at it. We're crossing over VWAP right now. They're selling into it a little bit. A lot of range on this candle here. Doesn't know what it wants to do, but crossing over VWAP to the upside. And looks like we did find a bottom down here on the S&P 500. Right about here. Hopefully. No, I'm seeing more dumping. I just seen Nvidia dump. What's that? 4091. And we're cracking that. So yeah, 10 minutes of terror, bro, is in effect. Look at that. But dude, look at Meta though. On the 5, Meta's trying to get back up here to VWAP. They're buying it. Look, increasing volume. Look at that, increasing volume. But Nvidia fighting with VWAP. Nvidia is dumping. I mean, if we crack this freaking level here, bro, like 4090s. I don't know what to say. Like, I mean, we already knew what time it was, though. As far as the 10 minutes of terror goes, we know about that. I've said it a million times on my streams. Remember, I was like, that can be a strategy in itself. You know, just watch the price action all day. And from that, you should be able to have a feel of what that 10 minutes of terror is going to do. Are we going to dump or melt up? You feel me? It's definitely a strategy, or it can be. I mean, you just have to work out the particulars of it. But I mean, 2 minutes to market close, dude. Everything's on the low right now. Actually, Tesla is front side, and I didn't have a chance to go over anything off the watch list. Let's see. That's Tesla. This one's been on there. This one's been on there. Up 1.5%. Neo up 2.5%. Netflix up 0.5%. There's another one that's been on the watch list for a while. Heron Therapeutics actually up 4.5%. Look, from pre-market it was at $2.20. At the highs it was, I mean, really not a lot of range on it, but still up 5%. Google front side. GameStop up 1.5% front side. ChargePoint up decent 4%, bro. 820s to 877 at the highs. It would have been a nice little easy stress-free play, and still trying to push up. Markets closed. Another one that's been on the watch list. Amazon closed front side, green on the day. AMC closed. Look at it. What did I say, bro? On one of my shorts, wasn't I like, damn, is AMC making another run at it? The apes, remember? And from the looks of it, it looks like yes. Still above $5. Previous close is now $5.50 and got up as high as $5.80. And still going, bro. Like, the apes might be doing something. Yeah, that's it. But anyways, bro, this is what we ended up looking like. Alright. That's what we ended up looking like at the end of the day, bro. Hope you guys was able to take advantage of some of that volatility and price action to trade off of. There definitely was enough of it. You know what I mean? Hope you made some money and you feel me? Had a green day. If not, I mean, there's always tomorrow. Remember, the stock market isn't going anywhere, bro. You know, you're gonna have red days. It's part of it. You feel me? But you know, the main thing is you always need to make sure that you live to fight another day. That's it. Know what I mean? As long as you can just live to fight another day, you're good. S&P 500 closing closer to the lows. Bonds like ran up going into the close. Nvidia basically in the middle between the high and the low, but closer to the low. But still, I mean, Nvidia is up decent, like on the year or on the month or whatever. Look at that dump right there, dude. Wow. What time was that? Oh, right after lunch. It's dumb. These are 10-minute candles though. Damn, son. But yeah, that's what we're looking like. Again, hope everyone did good and made some bread, bro. If not, always live to fight another day. But anyways, it's your boy E coming at you with some finance solutions. Okay, if you learned anything or found any value in the content, don't be afraid of the like button or even subscribe. If you're watching on YouTube, and rumble me up. If you're watching on Rumble, follow, hit the like or whatever. All that stuff matters, especially now. And again, like I said, don't be afraid of the like button or even subscribe. Hit the bell and get the hell over to my Discord and or Patreon to sign up for that daily morning briefing and watch list, which gives you that edge, brethren. Peace. And again, bro, that watch list, I'm telling you, like, tomorrow I'm going to have time to actually go over a lot of stuff. I have some free time tomorrow, the next few days. So we're going to go over it. Get some full days of streaming in, some good content. I'm going to go over the watch list and show you exactly what it entails, what benefit and how it will benefit you, and possibly, take your trading to the next level. If not, at least give you all the plays, with high volume, high volatility, decent range, stuff like that. And obviously any news pertinent to the stock market and what may and can affect you throughout the trading period. Decent information on there, bro. But anyways, like I said, peace. And peace to all my haters. See you later, alligators.